All right. Good afternoon, everyone. Thanks so much for taking some time out of your really busy holiday season. I know it is wild, and 2024 has just been a blur for I know so many people, myself included. But thank you for taking some time out this afternoon. I am excited to get to work with you here over the next hour or so. We are going to just take off. We're going to get after it, and I'm hoping you're going to walk away from today a little bit smarter, maybe a little bit more prepared for what the next 3 or 4 years have to give us. So first and foremost, thanks so much for joining. You're already taking that first step, right? We're interested, we're curious. Maybe we can turn that dial back in terms of what degree of uncertainty we are walking into as we are anticipating Trump's second term. Wow, it just seems like yesterday, 2016 happened, and a lot of people were surprised. But now we get round two. What does that look like for us, thinking long term, maybe even short term? I'm excited to get to share my work with you today. So I am going to share my screen. We are not going to waste much time here at all. We can go ahead and get started. All right. So you should be able to see my screen here with our lovely TradeWinds logo in the bottom right-hand corner. If you are unfamiliar with TradeWinds, allow me to introduce myself here personally, along with TradeWinds and what we look to do as a firm. My name is Miller Hoffman. I serve as our Vice President of Client Experience here at TradeWinds. If you are unfamiliar with TradeWinds, we are a registered investment advisor located in Raleigh, North Carolina. We specialize in really two main things, one being investment management and the second being financial planning. So what are we doing with our resources and the why behind it? Are we being as efficient as we possibly can? If that interests you, if that piques maybe a New Year's resolution for you coming into 2025, I am listing my email here in the bottom right-hand corner, or excuse me, bottom left-hand corner. That inbox is wide open to you. So whether you have a current relationship with TradeWinds or just checking us out for the first time, definitely want to invite you. That avenue is open, and I invite you to take advantage of it. This is also part two in terms of webinar series for this year as it pertains to the election or just politics in general. I'm going to have more information on the second slide, but if you are watching a recording or even watching me live here, I certainly want to invite you, go take a look at the first webinar that I did earlier this year. Before, of course, we know what's happened so far in 2024. Knock on wood, we are not finished yet with this year. But want to invite you as well, continue to interact with us in that way. For those of you who have already watched the first webinar I did, along with watching a recording, today is going to take a little bit of a different tone. Earlier this year was very fact-based, based in history. Hey, here's what we have seen. What does that mean for us as we approach and continue in the election season? Today is going to carry a bit of a different tune. We're going to talk more from a estimate or a projection, dare I say, speculate in terms of what the next 3 or 4 years could look like. Now, of course, I'm biased. I think these are pretty educated speculations, but the idea is we are looking into Trump's second term. And maybe more importantly, or most importantly, what is the actual impact on you? We know he's won, and we know he's coming in with a pretty red House and a pretty red Senate. Of course, the Supreme Court is more on the conservative side as well right now. What does this actually mean for you? So I'm titling our presentation today, Possibility, What Could Happen versus Probability. What is likely to happen? Now, if you're sitting in my seat, working with clients throughout the year and trying to manage my own path and navigation, I'm more interested in the probability. What's likely to happen? There have been a ton of promises made along the campaign trail, to be fair, on both sides of the equation. But now that we know that Trump is the winner, I'm more interested into really what does the next 3 or 4 years hold for us. So I'm basing the presentation today off of questions, common concerns, sources of confusion or maybe anxiety, along with sources of excitement that I've heard so far along this year. And I'm sure I will continue to hear as we move forward into the future. What a busy year we've had. Let's get started. 2024, my goodness, between markets and interest rates, inflation, of course, the election, we've had some global conflict in multiple parts of the world. 2024 has been a really wild year for so many people. And having a contentious election doesn't do anything to ease some of the fears and stress. If you're watching the webinar right now, you probably fall into two main camps. That first camp is those of you who are feeling really nervous, really anxious, and we're still kind of scratching our head around what happened. Um, you see a pretty volatile figure that Trump is with his ideas and the way that he communicates those ideas. And he's unpredictable, to say the least. We're not exactly sure what he's going to come out and say in the next minute and definitely over the next 3 or 4 years. So you're feeling anxious. There's that pit in your stomach that although we have a bit of a glimpse into seeing how he behaved in 2016 with his administration, what will be similar and maybe what will be different. I want to recognize that there's a lot of nervousness and uncertainty for a lot of you watching right now. There's also a camp of you that are very excited. You're looking forward to a second go around with an administration that you feel can fix a lot of the things that maybe you've been unhappy with during the Biden and Harris administration. You're excited. Trump gets to come into a second term with all the tools and experience he needs to best move forward with his agenda. This could be an exciting time. You're frustrated over the last 4 years, but now you're hopeful. Both things settle on the campaign trail, and as Trump is picking out his dream team to attempt to enact his agenda, you're excited. You're looking forward, and maybe even you're relieved. No matter which camp you fall into, ladies and gentlemen, we are talking about politics today. And politics is inherently an emotional topic because it's an inherently human topic. I want to get that out there first and foremost. Let me qualify. We're talking about a touchy subject today that's very sensitive. At the same time, I am going to make some generalizations in an attempt to move forward with the presentation. Of course, there are exceptions to every rule, but for our time, which is very limited today, I don't want the exception to make the rule. But I want to throw that at you here today. And here's how I'm attempting to do this. Let's move right along. Topics of discussion. I am looking to find a nice balance between high level. So what are the topics to really keep really forefront on the top of our minds, along with diving a little bit into the weeds. A pet peeve of mine is watching a webinar with an awesome title and the speaker proceeds to treat the next hour not talking about the title or the concepts that he or she alluded to in the beginning. So I want to find and strike that difference. Let's talk high level. What does strategy look like? What moves do we need to consider taking? Along within the weeds, let's talk through the T words that have been really popular to hear along the campaign trail, right? Taxes and tariffs, other pieces of legislation or things that Trump has spoken about and feels passionately about moving forward, along with governmental spending, a core part of GDP, which we're going to spend some time on today. I want you to walk away from the presentation this afternoon with an idea of how to keep score. Lots of rhetoric spilled on both sides, right? Saying we made the correct action or the other side did not. I want us to try to have an objective way for us to keep score so we can meet this time in 3 or 4 years and say, was the Trump administration a success from an economic perspective, from a financial perspective? At the same time, knowing that we exhibit biases ourselves. So a lot of this game is you versus yourself. I have some helpful tips and tricks to keep ourselves, myself included, as a fellow investor, keeping the train on the tracks here, as they say. Let's move forward and continue our discussion. This is a really busy page. It's messy, and I designed it that way as this are some of the topics or quotes that fly around my head really over the last year, and I'm highly probable or highly expecting them to continue. I have to start here as we are setting the table to really sink our teeth into the meat of the presentation, and that's really what a second administration looks like for Donald Trump and company. I have to point out a concept that is so important for us in the financial world, especially as financial professionals. along with you at home, who are investors, who have your own unique sets of goals, biases, traits, and previous experiences that may differ from everyone, certainly who is watching today. And this is an overview of a concept called the behavior gap. This is a really fascinating idea, and something that we've been tracking for quite some time. It's something that I personally track pretty closely. The idea is basically looking at the difference in investment return. So what are the actual markets providing us? What is the market return versus what is your return? You as an investor, the way that you make decisions or are advised to make decisions. The unfortunate part of the equation is there tends to be a large gap between those two. What the market gives us on one side and what we give ourselves on the other. The numbers are crystal clear. If we were to look at this chart here towards the middle, the average return over roughly the last 30 years, ending a couple years ago in 2019, was roughly 10%. That's roughly what we could expect and what we've seen over roughly the last 100 years, right? American markets giving us about 10%. Here's where things get ugly. The average stock investor has captured roughly half of that return. Now, half, when we talk about 5 or 10%, maybe that doesn't sound like a lot, right? That's only a small part of the pie. We're still keeping a good other chunk of that. I'm here to tell you that this can be detrimental to your financial plan and really derail you from the things that you find important and the whole reason that we invest in the first place. Is that retiring early and with ease or peace of mind? Is that saving up for a second property, that beach house or lake house that has been on the horizon for quite some time? Is this making sure we can cover healthcare expenses in retirement or raise a family you're expecting to have down the road? These are all very personal things, and we find that really ourselves get in the way of what our financial plan looks like, much more so than the volatility of the markets give us. Things get even uglier if we look at bond investors. So traditionally more conservative investors, they don't want the ebbs and the flows of the stock market, which can be very volatile at times, right? That pendulum swings back and forth to a pretty high degree. The average bond investor is getting whooped by inflation. This is really, really scary. If you are someone who is playing this game of I'm getting in the markets, I'm getting out, I change my strategy often, or I make really emotional decisions as it pertains to my investments, this behavior gap is the main culprit here in terms of what gets in the way of a successful financial plan. Now, I'm here to tell you today, having a plan and sticking to it is really, really easy until life happens. Until we have an election outcome that we don't love, until the news media harps on us over and over about things that we should be doing or should not be doing, until we have an event like COVID, where the world seems to stop and the loved ones we have near us really start to undergo some stress. Maybe we get laid off, or that department that we work for isn't really as strong as it used to be. Those things called life really attack us and really pressure our resolve as investors. This is the importance of having a good defense in play and setting appropriate expectations up front. I've heard these quotes that you'll see all over the screen, both professionally here in the office, just as we talk and meet with clients very frequently, along with just casually. These topics start around at a Thanksgiving table or a sporting event, or just seeing family members over the holidays. Things like, I'm just going to wait until things look better. It makes a ton of sense until we actually see the impact of this behavior gap and how detrimental that can be. Cash is king has been one I've heard pretty frequently, right? Interest rates are pretty high right now. Cash is competitive, but wealth, no one has ever built wealth off of owning cash and CDs. Can it be a really good play depending on which or what circumstance you're in as a retiree or as an investor, just in general? Absolutely. But again, we are looking back to the culprits of why is there such a variance between what the markets give us, so what these blue bars represent, versus the darker black bars here. I'll buy the dip, of course, here all the time. And of course, things just can't keep going up. We're hitting all-time highs. 2024, knock on wood, has been a fantastic market year that tends to pressure us to make a move one way or another. Time to take risk off the table, time to go all in, time to change my strategy because those talking heads on TV tell us to. Insert your favorite analyst from CNBC or Fox Business or whatever media network you may subscribe to. This is what makes it really, really tough to be an investor. I love this graphic here in the upper right-hand side. We tend to look at the past as full of missed opportunities. Hindsight is always 2020, right? We shoulda, woulda, coulda done a lot of things. Whereas as humans, we almost have an innate ability to see the future as unpredictable and something we want to shy away from or take our chips off the table. I really want to challenge you as we dive into what the next 3-4 years look like with the Trump administration. I am always going to start back with what is our driving force, what is point A, and what is point B. The truth of the matter is a president, a House, a Senate really has a small degree of impact on if we meet our goals, especially over the long term. I'm much more so focused on what's the impact of capturing or not capturing what the market tends to give us over time. This is tough to hear. I'm here to tell you there are three main sources working against you. One, yourself. We all have behavioral biases. We all remember that time. We have things that were taught to us growing up, and a lot of us didn't have awesome financial education, so we're kind of starting from scratch in many ways. Those people around you are against you as well, right? The guys on the golf course who are telling you what their advisor is doing or is not doing, on the pickleball court, just casually with what credit card points are going to be applied or what they're doing to reduce their tax liability at the end of the year. And the media at large, I'd say, is against you, right? The media is compensated to keep your eyeballs on the screen and keep you clicking and subscribing to their content. They're willing to say just about anything to get you to sacrifice your attention over to them. So it's really tough. This is the price of admission to being an investor, though. We have to be okay seeing some fluctuations and volatility in the markets. There is no perfect investment, and Wall Street is always going to revert to this trade-off of risk and reward. Our main job as planners, your main job as an investor is making sure we're comfortable with that amount of risk and reward that we are taking. You don't have to choose one or the other. Probably a mix of two may work best for you, depending on, again, where you are in life. I'd say the most important thing is we have a strategy and we largely stick to it. Let's make changes to your portfolio when your life changes, not when things outside of our control may force us to. But let's move on. I want to make sure we have plenty of time for Trump and beyond, right? That was my pet peeve, right? Want to make sure we have plenty of time to get to this. Here's the good news. Wall Street is your friend, and they are here to help you. The brightest minds that come from the best schools with the best technology, where billions of dollars are spent each year to create the best models. Thank goodness Wall Street gives us some awesome market predictions that we can really rely on and have a lot of faith in year after year. So thank goodness we can really lean on the Goldman Sachs, the Bank of Americas, and the Morgan Stanleys of the world. I'm glad they come out and give us great predictions and really set good expectations for what the year has in store for us. Oops. Except when we see how the results actually fall. This is really tough to fathom, guys. We trust financial professionals. We trust some of these larger banks with access to the best tools, with the brightest minds. We tend to have a degree of trust in them, right? They're part of that media. They're marketing to us. Here's the wild part. So I dialed the clock all the way back to take a look at 2024 as some of these major investment banks were coming into this year. What were some of the analysts predicting? What level would the S&P 500 reach or drop to throughout the year? If you're unfamiliar with the S&P 500, just think of roughly the largest 500 American companies, the Apples and the Amazons and the Googles of the world, along with some of these smaller companies that maybe aren't as large as the Apples, but maybe the next technology company that Apple was 10, 15, 20 plus years ago. Here's what's crazy. Moving into 2024, Goldman Sachs, Morgan Stanley, and JP Morgan roughly had the markets either at just level or even decreasing in value. In other words, you losing money, where a couple of them were a bit more generous. They saw some growth, but not a ton. This was one of the more generous predictions I saw, the S&P being at 5,400. As of December 16th, so earlier this week, the S&P is a little over 6,000. A wild difference between what Wall Street saw coming into this year versus where we stand right now. Goodness, take that in for just a second. This is wildly inaccurate and largely is something that we shouldn't pay much attention to. This is a part of the noise in that room and the markets and the people around us and even our own tendencies tend to be really challenging during these times when some of these groups that, are really large, right? They're well connected. They spend billions of dollars to try to get as close to this number as possible. This is a big stressor and something we should keep in the back of our minds as investors moving forward. Now, here's the deal. This works on both sides. 2024, a lot of these groups are coming in pretty bearish. Bearish meaning we're not too excited about what the future has to hold. We're not seeing there being a ton of bright light. It may make sense for us to hold on to what we have. These predictions may look quite a bit different going into 2025. They may be pretty rosy. They may be saying, hey, we are expecting some higher levels of growth. We like the Trump administration coming in. We like lower taxes, less regulation. Yeah, the tariffs may be a little bit of a deal, but we'll get through it. The same idea here is still in play, right? We should not take these estimates or predictions as gospel and really just as another way to derail our train. So really tough. As we speak right now, the markets are up roughly 27% just this year alone. Wildly different than Goldman Sachs predicting, we're not going to have any growth this year. And definitely Morgan Stanley and JP Morgan saying we are actually going to lose this year. Pretty wild to think of it that way. Let's transition though, as promised. Let's talk more about the administration and what's going on here. What am I thinking is going to the next 3 or 4 years going to look like? I had to set the table though with some behavioral finance and that behavior gap, right? No matter what the rest of the presentation brings, of course, we're going to speculate and attempt to estimate as best as we can. Ultimately, our success or failure largely rest in our hands. No pressure, but we at TradeWinds are here to help you with that. How can we stay on track and make sure you are comfortable for what the next, 3 or 4 years have? I want to spend and really model the rest of the presentation around this GDP calculation. GDP stands for Gross Domestic Product. This is the way that we gauge the economic progress or not so much progress-wise, maybe drawing down a bit of a country, the U.S. being included. We tend to see this expressed as a percentage. Hey, the U.S. economy grew by 3% in 2023, or the French economy shrank by 2.3% last year. GDP is not a perfect way to gauge the overall output of a particular country. But I love a Winston Churchill quote. He was talking about democracy. He said, democracy is the worst form of government except for all of the others. So there are a lot of ways that we can look to judge how well or how poorly a country may be doing. GDP really seems to be that more standardized way of how do we calculate that and what do we stick to year after year after year. I want to put this in context because these numbers can be really, really tough to fathom. If we just look at where the overall output of a country, the value, let's say, of a country, the U.S. stands at almost 30 trillion. I'll willingly admit it is impossible for me to fathom the size of what that looks like. And if we look at things like the goods and services that you and I consume, the investment businesses are making, how much the government is spending, along with what's coming in and coming out of our country, it is virtually impossible to fathom the sheer size and scale of GDP. I also wanted to list kind of the podium here. Who's on the board? China runs in second place here at about 18 trillion. In third and fourth place, there is a pretty steep drop off. Germany right around 5 trillion and Japan a close fourth around 4 trillion. Here's the takeaway of this page, and here's why I think it matters. Having an economy that has $30 trillion wrapped up in it, right, in terms of a valuation perspective, our economy is more complex than it's ever been. It is more connected than it's ever been. It has more people doing different kinds of jobs and different kinds of places than we've ever seen before. I think this should be a shining star in terms of giving you some confidence in terms of what the next 3 or 4 years look like. It would be really, really difficult for one person or even a party to destroy a lot of the value that makes up America from an economic perspective. What I'm not saying is that there will not be an effect and a push and pull back and forth. Certainly that is the case, and we're going to unpack much more of what that means and what I see on my end. But guys, we're looking at an economy that is so large and so complex, and an administration that the clock is almost already ticking for what they can or cannot accomplish. Let's unpack the four main components here of GDP. Consumption is maybe the easiest one to fathom. It's what you and I buy, or the services that we partake in, not just as consumers, but what we also bring to the table. What do you do as a job? What kinds of products do you buy? How do you benefit for yourself and your family or your loved ones around you? And that's the same way for the person sitting on the other side of the table. What are you buying? What goods? Are you buying Coca-Cola or Pepsi? And what services are you interested in? This makes up the vast majority of GDP. Roughly 68% of GDP in 2023 could be attributed to what you and I are spending. Running a close second to that, and it's a horse race here right now, is investment and government spending. Think of investment as being more business related. What are businesses buying? What are they investing in terms of innovation, new technology, new ways of working, along with creation of new goods? That came in around 18% in 2023. Government spending is really close to that. So think of the main three hitters here: Social Security, Medicare, and defense. It makes up about 17% again in 2023. We're going to unpack what this looks like moving forward as government spending is a big line item on the Trump agenda, and there's been a lot of rhetoric around what does that look like, and again, what is likely to see in terms of an outcome of this. Along with net export, surprise, Trump is really targeting using tariffs, re-examining our trade deals, what's coming into the country and what is going out. It's really no big surprise that he's targeting a handful of things that have a direct impact on these four components. That's how I've organized the rest of our discussion for today. So these four things added together, the U.S. really presents these on a quarterly basis. So how well or how poorly may we be doing? So it will be interesting for us to watch very closely, right? Are the policies or the things that Trump wants to do, how much of an impact does it have on these four core items? And of course, these four items are very complex and probably deserve a webinar on each four of these in depth. But at least for today, I want you to have an idea. For us to objectively keep score, we are going to look at the impact on these four items and beyond. Trump, of course, is probably the most pro-stock market president, really in recent history, maybe ever. What I mean by pro-stock market is he alludes to it frequently. He uses it as a scoreboard. It's something that he really touts as the reason that he won the chair the second go around, or maybe third go around, I should say. So we have a way for us to keep score and hold him accountable with that being said. Let's unpack this more and more. So let's talk about consumption. Remember, this is the largest percentage of the GDP calculation, what you and I are spending. This is a chance to really re-examine the most important or the heaviest weight of the calculation, and something that has a direct impact on us too. I want to start by talking about the Tax Cuts and Jobs Act. So let's get specific here. Here's one of the in the weeds topics that we'll explore. Individual taxes, bar none, if you see this graphic in the upper left-hand side, are the most important revenue source for Uncle Sam. The taxes that we pay through wages and working, selling properties, or taxes on said property, the investment taxes that we all pay, along with other income sources like Social Security and pensions, for example. You'll see that these make up a large portion of what the government collects from a tax perspective. You'll see individual taxes, social insurance, so think of like public benefits, Social Security being one of the more popular ones, consumption taxes like sales tax, of course, property taxes, if you're a homeowner or own another asset where property taxes are assessed against. And we see corporate taxes making up a pretty small percentage of that. We take a look at the aggregate country. Remember, the United States has about 330 million people. Now, not every single person is actively working and contributing to retirement accounts or spending a large amount of dollars, but the Tax Cuts and Jobs Act is really targeted to impact each and every person in the country. To rewind here just a bit, the Tax Cuts and Jobs Act is often called the Trump tax plan. This is one of the high marks I think that the Trump administration would point at as success in the 2016 administration. He passed these tax cuts in 2017. They went into place in 2018, and it had a built-in expiration date ending in 2025. So it is still alive, but it is on life support. If the Trump administration does not take any action, the Tax Cuts and Jobs Act will expire, and we will revert to the rules that were in place before 2017, before the Tax Cuts and Jobs Act was passed. Here's a point of speculation on my end. I see there being a high likelihood that the Trump administration looks to not only continue and revive the Tax Cuts and Jobs Act, but also have some proposed additions as a part of it. We've heard a ton of stuff being promised or thrown out along the campaign trail, but here's what Trump has said, and I want to evaluate the likelihood of seeing this implemented. Tax break on Social Security. So remember, Social Security is taxed in mainly two different ways: at the federal level, Uncle Sam, and then at the state level. Depending on the state in which you reside, like North Carolina, for example, your Social Security benefits may not be taxable. It may just be a tax-free, lovely benefit you get for the state. But all 50 states that we have here are on the hook for Social Security taxation at the federal level. What the Trump administration is proposing is that the federal level takes a step back in terms of taxing Social Security, which would mean roughly a fifth, 20% or so of this pie chart pretty much is wiped away in a pretty quick time frame, or at least drastically diminished, depending on how states behave. We've also heard promises on no taxes on tips or overtime, really appealing to workers, especially those who work in more service-based industries or ones where a large amount of hours are being worked. We may have heard about the SALT adjustment, SALT standing for state and local taxes. The law of the land right now is this is capped. So actually on your federal tax return, you're able to deduct, or certain taxpayers are able to deduct, both state and local taxes, things like property taxes, for example. The Trump administration has flirted with either just getting rid of this cap in the first place, or maybe just doubling the cap from where it sits right now at $10,000 to $20,000. This would be advantageous more so for people in high cost of living states. Like think of our states in the Northeast, New Jersey, New York, along with states on the western side of the country. Think of California and Washington really comes to mind for me. We're going to spend more time on the corporate tax rate on the next slide, right? That investment and what impact that has. It's showing up on the consumption side, as I think that does have a direct impact on how many dollars are left in our back pocket. Objectively here, I talked about this a little bit in the first webinar earlier this year. Objectively, tax rates are lower as a result of the Tax Cuts and Jobs Act. The proof is in the pudding here. I pulled a chart here of single filer. So if you're married, filing jointly, your tax rates will look a little different. You can just compare and contrast the percentages. If the TCJA, Tax Cuts and Jobs Act, expires versus the law of the land as we see right. Pretty much across the board, they are lower or at the very least match. So we see some commonality here between 10% and the 35% bracket. Now, what does this mean? This means more money will end up in your back pocket as it pertains just specifically to taxes, but at what cost? Now, that's the more existential question. Remember, governmental spending is still a core component of that GDP equation. So if the government is not being able to spend or their tax revenues are quite a bit lower, what does that mean in terms of the aggregate calculation? I am in favor of seeing what the consumer or how the impact of consumption will look like as a result of lower taxes, both at the individual level and at the corporate level. I also think Wall Street is a fan of that too. Right? If companies can almost instantly decrease a good chunk of what their budget looks like just because they're paying less for taxes, that tends to be a pretty good thing for business. With that being said, we are really dealing with a government that is large in size, and we have a heck of a lot of things to pay for. So we will naturally see some cause and effect as a result of that. And of course, it wouldn't be a presentation that I did without a cheeky little political cartoon, right? It says reforming this one may prove easier. There's a huge taxes book, and then there's a tombstone that says death. The only two things that are certain in life, right? Death and taxes. Looking to make some fun here, reforming the death policy instead of the tax policy. Again, to reiterate, keeping more dollars in your pocket, but I think we're going to see that having a pretty clear effect on that GDP, or specifically the governmental spending part of GDP, which is another part we'll jump to here in just a bit. I could highly expect to see Trump doing something with the Tax Cuts and Jobs Act, looking to revive this and making some of the additional changes he would want to see. Moving forward, Trump and investment. It is no surprise. I have a beautiful collage for you there on the left-hand side. Trump loves the business community. He talks about it frequently. Again, he touts this as an upside to what he did in 2016. I think it's highly probable we see him look to continue this, not just attracting businesses, but keeping them here. Now, here's the downside to that. He has a couple of plans in place, which we'll get to in the net export section, about ways to pressure businesses to stay here through the use of tariffs. If you guys recall, depending on how good your memory is, Trump and Harley-Davidson went to bat in his 2016 term. There was a lot of public comments back and forth, and really Trump targeted them as moving some of their operations overseas. He really called them out, which wasn't super favorable for Harley-Davidson in the meantime, or in the moment rather. But we've seen Trump as not being afraid of calling out American businesses and using the tools at his disposal to influence their behavior, to put it neat, or put it nicely. The same thing with Ford, right? Along the campaign trail, Trump talked often about car companies taking operations to Mexico as just an example. He's really, touted trying to keep some of these companies here and keeping manufacturing still here in the United States. It's one of the ways that I think in the most pro sense, he's attempting to defend American interest, maybe at the detriment of seeing how the free market may operate without some of the Americanism in the conversation. Trump is going to rely on seeing these big headlines that look really cool, right? The SoftBank investment that was just made a couple days ago of $100 billion. This is roughly twice the investment that was made in 2016. I don't think the Trump administration smiles any more or any harder than they do when these types of news and headlines come out. I think we could expect to see the Trump administration being really, really interested in trying to attract businesses again to come to the United States, move their operations here, and he's willing to use whatever tools necessary to keep them here. I mentioned that second bullet point here being the most pro stock market president we've ever had. That was a quote from CNBC. Trump tends to talk about the markets pretty frequently. He uses it as a measuring stick for his progress or the amount of work he's done for the American people. With that being said, here's the truth of the matter: 14% versus 12%. If we were to compare the stock market used by the S&P 500, so again, America's roughly 500 largest companies, the Biden administration actually outperformed the Trump administration in a relatively short amount of time, right? We're talking about 4 years and 4 years. 8 years is a relatively short amount of time, especially when we look at the ebbs and flows of the equity markets. 14% versus 12% would be the true comparison between the two. Even if I take some of the COVID shocks out of the equation, the Trump administration still underperformed by 0.5%. This is something the Biden and Harris campaign did what I think a poor job of explaining or touting during the campaign trail. Trump won handedly on the economy with a lot of people, a lot of voters who trust Trump more with the economy and his business acumen than Harris. But what will we see come from 2024 to 2028? I guess only God knows. I certainly do not know exactly what's going to happen for the next 3 to 4 years. The last thing I'll throw your way is consumer sentiment. I included a little chart here of the S&P 500, not as a bellwether of what the next 3 or 4 years is to look like. This is just since really election day, right, early in November of this year. We've seen the markets behave pretty favorably since early November. Interestingly enough, if we look at the volatility in 2024, October was the least volatile month throughout the year. So a month leading up to a really tough campaign cycle featuring indictments and assassinations and a change of candidates, a really, really rough election cycle. October was actually the smoothest ride we've had all year. And we'll see how, of course, December winds up. Remember, the stock market is an American invention, right? We have created it to try to be as black and white as possible, but a lot of this still pertains to how we are feeling as consumers. The University of Michigan does a really good job of tracking how people are feeling. I believe it's month to month, or at the very least quarter to quarter. So much of this has to do with our expectations. How are we feeling coming in? Are we optimistic? Are we pessimistic? Are we excited about the next 4 years, or maybe not so excited? We're seeing consumer sentiment hitting almost all-time highs here, at least in relative history, so far moving into the Trump administration. Now, here's my fair warning, right? We spent some time talking about the big banks and the big investment banks making their projections coming into 2024, not so optimistic, and 2024 has turned out to be a really solid year. The opposite can be true. We will see the impact of Trump's 100 first days, especially how hands-on he wants to be with some of his economic toolbox. We're going to spend some time talking about tariffs here in just a second. But we could stand to see quite a bit of shifts here in 2025 and moving forward, despite consumer sentiment being at an all-time high. So the herd mentality is really attractive. It makes sense for us to all to be in this thing together. That doesn't mean we have any better idea of what the future can hold. So really careful here in terms of Trump and investment. I think he's sensitive to the business world. He wants to attract them here, but he's also willing to call them out and ruffle some feathers along the way. In the short term, we could see some volatility as a result of that. And maybe he doesn't get the same benefit of the doubt that he received in 2016. This time around in 2024. We'll continue to move right along. All right, Trump and government spending. Wow, what a big and heavy topic, and there's a lot to unpack here. Let's spend some time looking at this graphic, and I want to give a shout out to SEM Wealth here for putting this together. They basically looked at 2023 tax receipts. So all of the tax inflow that has come from, of course, individual taxation, which we now know is the primary driver of the tax receipts in the country, along with business taxes as well, those two being the main factors coming in. These numbers are scaled down so we can try to fathom them or work with them in a more meaningful way. But we have a bit of a problem here. what we're looking to bring in from a receipts perspective in 2023. By the way, 2024 looks awfully similar, even worse than what these charts illustrate. Where is all of our government spending going? It's going to three main places: Medicare, Medicaid, Social Security, and our defense budget. And if we were to just look at these three main items, line items here, the tax receipts are barely covering just those three alone. And that's before we talk about anything else. Now, here's a popular misconception that I've heard really from both sides of the campaigns moving forward, and certainly from the Trump campaign. These welfare programs and other departments like the Department of Education and Transportation have really been targeted. Certainly, I imagine there is waste there, ways to be more efficient. But if we're looking at this on a relative scale, these actually account for not the original source of the problem. We have these three much larger entities or aspects of our government where all the tax money is going. So we have a deficit that we are almost certainly going to run again in 2024. Deficit would be the year to year. How much is the shortfall year after year? And that ultimately adds to our debt. Our debt has never been higher. I'm going to try to, stop sharing here for just a second and show you that link. Let me share screen here. All right. Heart attack comes in 3, 2, 1. This is the U.S. debt clock. It attempts to continue or keep score of how much we are in debt as a country. So a little over 36 trillion with a T. And these numbers are very active, going in the wrong direction. Trying to make this a little larger here. Remember, largest budget items, what we just covered: Medicare and Medicaid, Social Security, defense, and the interest is more of a problem now than ever. It's a little over $1 trillion or so and counting just in interest. Remember, as I stop sharing my screen, and we will get back to the presentation. Remember, the interest on our debt in 2023 was not nearly as large. Let me try to skip through this. Hang tight. Interest on debt in 2023 was not nearly at the level that it is now and counting. So if we have a question of why is this DOGE, the Department of Government Efficiency, in place? What is it designed to do? And the impact it will have on me, it's really no surprise that the Trump administration is trying to target this as a way to better this GDP number. Now, this is a bit counterintuitive. You may say, Miller, but government spending makes up for almost 20% of GDP. If we stop spending so much, will that not impact our GDP score? The simple answer is yes, it will. Government is at an all-time high in terms of its size, which has helped our GDP numbers year after year, decade after decade. With that being said, the hope of the Trump administration, which I think is a friendly hope, is that we are going to be more efficient in how our government spends dollars. We will see what the likelihood of that is. I think the DOGE and the ideas of Musk and Ramaswamy as being some of the two more figureheads of that department. DOGE really operating as an advisory council, not having any real power. I think a lot of the rhetoric around coming in with a chainsaw and cutting programs and entire departments, I think they may find it's a little harder to operate in the governmental space, and the amount of impact that has on individuals, families, and just the norms of how we operate as a country. I think they'll find it's a little bit harder than to just go in and cut, which is that last bullet point. It's much easier to say, let's just get rid of the Department of Education versus saying, how do we optimize this? How do we cut the inevitable wasteful spending, of which I'm sure there is some, without completely raising departments in the first place. The interest on the debt is the exponential issue, right? This is The investments work in the same way that debt works, but not so good of a way, right? Our investments, the more we leave it in, it compounds over time, right? So if we can put it in and largely leave it alone, the expectation is it grows over time, and we're growing on that growth. Debt works the same way. The more we borrow, the more we say, hey, we need to lend some dollars, the more our debt or the interest that we pay on that debt gets, which gets us closer and closer to being unsustainable. So what am I thinking here? I think the Trump administration is looking to outgrow a lot of these problems. We have a very large government and a lot of things payable, promises we've made to people approaching retirement, so like for Social Security purposes, from our healthcare program, right? Medicare for mainly people starting that in your mid 60s and for the rest of your lifetime, while still continuing to protect our interest of America, either at home and abroad. So we have quite a bit of things that we spend dollars on. I think on one side, the Trump administration is attempting to optimize this. What can we cut? How can we bring ourselves back into budget? At the same time, I think there is some underestimating in terms of how easy that will be and the impact that has, both on the individuals themselves, but also the economy at large, too. Remember, the U.S. government is one of, if not the largest employer of people in the United States. If we start going and slashing large departments all in one fell swoop, we could find ourselves in quite a bit of a volatile period, to say the least. Trump could also lose interest pretty quickly. And if we see slashing of departments and a big impact on GDP, may turn down his interest in looking to continue his path. I know we are about 10 minutes or so out, but I want to spend some time on net exports. Remember, net exports meaning what are we bringing into the country versus what are we shipping out. And so let's spend some time on the tariff side of the equation. And I want to give you a really neat investment opportunity. I am looking to start TradeWinds Lemonade Incorporated and would love for you to be an investor. Let's say we start a lemonade stand and we have three main ingredients or goods that we need to source. Of course, we need water. We need a heck of a lot of sugar. We also need lemons. But for us to get this inside of the United States, it's really expensive. And that's going to weigh on our abilities to generate revenue and keep as much profit as we can. We're going to go to France to actually import our water. France is one of the highest exporters of water in the country. So they're going to give us a really good deal. They're doing it at scale. We'll just import our water from France. We're going to apply that same rationale to Brazil for our sugar, along with Spain for our lemons. Brazil and Spain are the leaders from an export perspective, both for sugar and for lemons, respectively. Here's how this is going to work, or what Trump really is targeting is, instead of us being so reliant on France, on Brazil, and on Spain, he is going to tax those imports as they come in to make it more fair for the American water companies and for the American sugarcane fields and for those farmers growing lemons here in the United States. This is an idea that makes a ton of sense in theory. Right? Let's level the playing field. Let's make sure we're protecting our interest as a country, but really poses some significant issues when we peel back the layers here a bit, especially when it comes to free markets. Put that last bullet point on here. Tariffs are so 1930. To give you a quick history lesson, in the 1930s, or at least a couple years before the Great Depression, which if you're a student of history, you know 1930s was synonymous with the Great Depression. Two leaders of our country, Smoot and Hawley, a senator and representative in the House, wanted to make some steps toward protecting the agriculture here in the United States. So as the United States was shifting more to industrial or making things, the love for the agriculture and that industry here in the United States started to wane a bit. We started to import more and more of our crops, food. Smoot and Hawley were sensitive to this, and so they introduced a really neat idea for ways to tax both the imports of the crops coming into the country. What turned out to be just a handful of things to tax actually turned into, I want to make sure I get my number right, over 20,000 goods by the end of everything. A lot of economists were vehemently against this and actually pressured Hoover quite a bit to not sign these moves into law. Long story short, the Smoot-Hawley Act is really attributed to one of the downfalls or something that brought on the Great Depression and really kept the U.S. economy down for quite some time. Are we at the levels of the 1930s? That's why I include this effective tax rate. We are not. With that being said, we are talking about a pretty significant jump if the proposed tariff rates under the Trump administration was enacted. So tariffs are not new. They have been in place for quite some time. And in fact, the Biden administration pretty much left every tariff in place that the Trump administration, the first administration, did, while actually increasing a handful of them. I included this headline down here on the solar panel components. With that being said, I think Trump opens himself up to some criticism here on the tariff side. Winning solves a lot of problems. We can use, Trump ideally looks to use this as a tool or a pressure point for a lot of the companies that we trade, or a lot of the countries rather, that we trade with. Mexico, Canada, China, and India, just to name a few. Trump is attempting to outgrow some of our problems and re-examine our trade deals that we have with these countries. So if you think of the iconic or infamous, depending on your perception, red hat that the Trump that Trump wears all the time, it says "Make America Great Again," not "Make free markets great again." As a capitalist myself, I don't love the idea of taxing goods coming into the country. It really creates artificial pricing that drives the price up for, you guessed it, me and for you. American companies aren't going to bear the brunt of this. A lot of them are smart enough to pass those costs right on down to us. Are we in store for another 1930s Great Depression as a result of the tariffs? I think that would probably be a bit of an overestimate here in terms of what's to be expected. Will it cause some pressure on both industry in the United States and our relationship with other countries in the world, specifically when it comes to the economy and finance? Absolutely, it will. So we'll see how long Trump can promise these really high tariffs, and for what amount of time does he intend for them to be used for. Let me wrap up here quickly. Here's what you can do. We have a natural urge as humans to do something. Just leaving it alone and keeping it at an arm's length is really, really difficult for a lot of people. But here's what you can do. Examine your relationship with money. We are going to be on a wild ride. No matter who was elected a month or so ago, we're going to be on a wild ride nonetheless. Think about what the last 4 and 8 years has thrown away. We've been on. But that wild ride doesn't have to be a negative one. I am always going to bring our attention back to thinking longer term, not in terms of 40 years in order for you to be a good investor, but thinking and adopting this kind of a mindset in pursuit of peace of mind. So examining your own relationship with money. Are you taking an appropriate amount of risk that you're comfortable for and that is required to meet your goals? Are we overextended? Are we underextended? And who is your trusted source? Who can you bounce these ideas off of that won't confirm your biases, but will offer great advice and trusted counsel? I hope you walk away from today having a bit better idea of why Trump is fixating on a handful of things that have a direct impact on that GDP calculation. All of a sudden, we're not going to be super surprised when he wants to move forward with the tariffs and DOGE starts projecting or proposing rather moves to make to cut government spending or to optimize. He's going to want to cut taxes to stimulate people spending more and more. That's the consumption side. And he also wants to cut the corporate tax rate, in some cases, somewhat significantly. That's what would lead, I think, the Trump administration to think they are going to spend more to invest in their operations and their goods and their services, thinking over the long term. We've covered quite a bit here in a short amount of time, and I've taken definitely a quick and simplistic approach to a handful of these topics. I am more than glad to dive in deeper with you one-on-one. Send me an email. We can set up a call. We'd love to have you into the office or set up a Zoom chat or video chat as well. Keep your head over the next 3 or 4 years, and we are in that same boat with you, and we have an oar in hand. We are ready to row with you. Lean on us. We're here for you. And lastly, thank you so much for your attendance today, and have a wonderful, happy holidays. You take care, and here's to 2025. Thanks, everyone. Bye.